What's up, guys? Welcome back to Financial Dad. Appreciate you guys tuning in. So just a little bit of background on me. So my name is Gus Robertson out of North Carolina. I've been in the financial services field for 24 years now. It's crazy to even say that. So, but what we focus on more is financial education, whether it's through insurance. And whenever I say insurance, everybody always defaults to, oh, well, he's selling life insurance. We don't do life insurance. I did life insurance for years with a captive company, but I think that insurance is a tool and not an investment. So just wanted to clarify that. We focus on insurance, financial products, and then we have a whole separate division that is based off of commercial property, all that kind of good stuff. So my background is very diverse in regard. I think it's all financial. It's just one big circle with a bunch of brothers. So today's episode is basically just answering a question that somebody had a couple weeks ago about escrow. And escrow is to do with your homeowners. It's a super boring thing, but it will hurt you if you don't manage it properly. So think of an escrow as just a savings account. It's your mortgage savings account. That's all it is. And the question that was asked a couple weeks ago is, why was their escrow account negative? And so let's just be straight whenever it comes to the two main things that make up your escrow. It's also called an impound account, but think of it as a bucket. It's just a bucket. And whenever you make your payment, so let's just say your payment's $1,000 for your mortgage and $200 of it is escrow. That $200 goes into the bucket and just sits there. It just sits there and piles up month after month after month until those two bills, the two main bills, everybody's escrow is at least made up of two things: insurance and taxes. And so when those two bills are ready to be sent out by their respective places, so from the insurance company and from your county tax department, it's sent to your mortgage company, and then the money is taken out of the bucket and it's paid. And so that's your escrow or impound account in a nutshell. There are other things that can be in your escrow, so insurance and taxes, but it could also be flood. It could also be PMI. So PMI is called private mortgage insurance. So that's kind of an extra amount charged on top of your loan if you borrowed more than 80% of the purchase price. And so it's usually a relatively small amount, but that's what makes up your escrow. And so where I see people mess up is your insurance and your taxes will never go down. So everybody just needs to be okay with that, especially your taxes. Your taxes will go up every single year, if not by just a very small amount. And it goes back to, like, how do you boil a frog? You just turn the heat up super slow. And so that's what taxes are. So if your taxes go up by $10 or $20 or $500 every year, then your escrow would be negative, because your escrow is based off of what the prior year's was, not the new year. And so let's break that down a little bit. So this account is very easy to manage, and it should be managed specifically by the homeowner. Nobody's going to do it for you. You can pull your account up online, or you can look at your last mortgage statement. So when you look at your last mortgage statement, you will see it line item right there, and it says escrow. So you get your latest tax bill, you get a copy of your insurance declaration pages. You can call your mortgage company, or if you look at your statement and see if there are any other fees in escrow. But for right now, let's just say it's taxes and insurance. You take those two bills, you add them up, and you divide by 12. And if your escrow that you are putting into your mortgage is less than what those two bills are divided by 12, then you're going to be negative. So that pretty much answers her question, is that obviously her insurance and her taxes went up. And so when those bills were due again, the escrow is going to pay it. Escrow is going to pay negative. So if $3,000 of bills came in and there was only $2,500 worth of money there to pay it, they're going to pay the $3,000. Then they're going to send you a bill for $500. And actually, they're going to send you a bill for more than that, but they're going to let you know that your escrow was upside down by $500. They're going to ask you, do you want to pay this bill over the next year? And they'll kindly set it up over a 12-month payment, no interest, And that's what a lot of people do. But where people get messed up is if the mortgage company knows that your escrow was $500 lower this year, then they know that that bill is going to be $500 lower next year. So actually what's going to happen is you're going to get a bill for $1,000. And it always comes at the most inopportune time. Most people, what they do is that they get so used to that mortgage payment. And a lot of people, just call it like it is. People max out the amount that they spend on a home. They get used to that $1,000 payment. And then they get a bill saying, oh, well, you don't owe $1,000, you owe $1,100. And for a lot of people, that's a hardship. And so, or at least aggravated enough that it's a hardship. And so what I would do, and I do this, just get those two bills. Find out what makes up your escrow and add them up, divide by 12. And if your escrow is not taking out enough money into your out of your mortgage payment to drop into that bucket, then you really need to either increase how much you're putting into escrow, which is a line item on when you make your payment, or figure out how to reduce your escrow. And I'm just going to just say it. Most of the time, the easiest way you cannot manipulate taxes. You can't manipulate PMI, even though it goes down based off of you paying back your mortgage, but is your insurance. So the easiest way to reduce your escrow is to make sure that your insurance premiums are in line. And so I tell all of my clients, even with me, see, I'm a brokerage. So I tell all of my clients whenever I bring them on, about every 2 years, we're going to check the rate. And we do that for them. And why do we do that for them? Just as a little aside here, is because I don't want them going anywhere else. If their renewal premium is $1,400 and I know that I can do it for $1,200, I would rather just go ahead and switch them and retain them as a client. That's what you get with an independent broker. That's just a little what's it called? Like a little pitch right there. Yeah, a little plug. But but those are the main things in regards to escrow. And so a couple of things in regards to that. So always know where your escrow stands. I tell all of my clients, if everything is managed properly, I always tell people this: if it's affordable, always add an extra amount into whenever you make your payment. There will be a line item right there. If you write checks, and there will be add extra for escrow, or if you do it online, you can do it there. I would go ahead and add an extra 10, 15 bucks, depending upon your how much your escrow is. If your escrow is $400, add 20 bucks. That way, if it does go up, you have enough money there to pay it, and you've paid throughout the year instead of, and there's no negative. So the top two things that you need to know about your escrow impound account: take all the bills, insurance and taxes, add them up, divide them by 12. That's your number one thing. And then the other one was the only expense that you have in your escrow that you actually are in charge of is your homeowners. So just check on those premiums every couple of years and you will be good to go. But other than that, I hope that helps out on people understanding how your escrow impound account works with your homeowners, with your mortgage. And if you have any questions, you can email the Financial Dad Podcast at Gmail. And I appreciate you guys listening.